Today we're digging into a really fascinating market report from July 4th, 2025. It really paints a picture of intense struggle, some key turning points, and honestly some surprising forces at play.
Absolutely. And our mission here is to unpack the sources you've shared, try to understand why the market did what it did today, and maybe get a sense of what's coming next, in the very near future.
Okay, so let's start with the big picture. What are the sort of key insights jumping out from today's sources?
Well, I think there are three main things. First, despite all the downward pressure and the struggles we saw, the market seems to be settling into a consolidation phase.
Consolidation, okay.
Yeah, specifically Nifty. The expectation, strongly suggested by the data, is for it to kind of hover between 25,000 and 26,000, at least for the next week or so.
That's based on actual data, not just a feeling.
Oh, yeah, definite data points we can dig into. Second big thing, the ripple effect of a regulatory shock. The SEBI ban on Jane Street.
Ah, yes, that hit the news hard.
It did. And it really rattled some key stocks, showing just how interconnected everything is. And third, you can't ignore the global stuff. Geopolitical chatter, specifically about tariffs, adding another layer of volatility.
Okay, that sets the stage nicely. Let's dive into that consolidation story first. We need to look at the day's actual moves. Nifty on July 4th. Quite the ride, wasn't it?
Definitely a roller coaster. Our sources point out it had fallen for the last three trading sessions. And that third day's low, that became really important today.
Right, I've heard traders talk about the significance of the third day's low in a trend. What actually happened there?
Well, it often acts as a potential support level. And if it holds, it can signal that the selling pressure might be easing up.
And did it hold?
It got tested. Nifty future dipped down to almost 24,400 at one point. Quite a dip.
Wow.
But then, and this is the interesting part, it staged a pretty significant recovery. Bounced back about 150 points by the close.
And that happened even with weaker European markets and U.S. futures looking a bit grim.
Exactly. The backdrop wasn't exactly encouraging, which makes the recovery more notable.
So despite that pressure, the Nifty candle itself probably ended up green today, breaking that 4-day losing streak.
Likely, yes. But we shouldn't, overstate the positivity there.
Right, not a massive turnaround signal necessarily.
No, more like a pause, a breather. Breaking a streak of red candles is good. It suggests the downward momentum is slowing, but it's not a strong buy signal on its own. More like the market fighting to find a floor.
Okay. And Nifty wasn't alone in this volatile action. Bank Nifty seemed to be having its own battle, particularly around 57,000.
Oh, absolutely. Struggling is a good word. It fell, 200 points and shot up 400 points.
Wow. Down 200, up 400. That's turbulent.
It really is. That kind of whipsaw movement screams indecision.
Yeah.
Buyers and sellers are really battling it out, reacting fast to everything, high uncertainty.
So all this back and forth, the Nifty dip and recovery, Bank Nifty's wild swings. How does this tie back to that consolidation thesis you mentioned? The idea that Nifty might stay between 25K and 26K.
Well, the evidence gets pretty strong when you look at the options market.
Okay, tell me about that. What are the premiums showing?
So, for instance, the 26,000 call option, it was trading really cheaply, below 10 rupees for a while. It recovered a bit, maybe to 12 or 13, but still pretty low.
Meaning not much expectation of Nifty going above 26,000 soon.
Exactly. But then you look at the puts, the 25,000 put option, it still held a decent premium, around 20 rupees.
Ah, so there's still some perceived risk of falling towards 25,000, or at least value in protecting against that.
Precisely. Cheap calls, puts holding some value. It suggests resistance overhead, but also support below. A classic sign traders expect a range.
And does the open interest data back this up? Our sources mentioned aggressive selling of both calls and puts within that range.
It does, very strongly. You see significant open interest buildup from sellers of calls, starting from 25,500 up to 26,000.
So betting against a move above those levels.
Right. And at the same time, aggressive selling of puts from 25,500 down to 25,000.
Betting against a move below those levels.
You got it. When the big players are selling both sides like that, they're essentially boxing the market in. They expect it to stay sideways, at least for the next few sessions leading up to the weekly option expiry.
That makes sense. And you mentioned TCS results are coming out next Friday.
Yeah, after the next weekly expiry. So that potential market-moving event is out of the picture for this immediate consolidation period.
Okay, but here's a twist our sources flagged. The money flow today, FIIs and DIIs, both net sellers.
Yes, that was surprising, wasn't it? Both foreign institutional investors and domestic institutional investors were net sellers. Combined, it was about 2,000 crore pulled out.
which definitely helps explain that initial downward pressure we saw earlier in the day.
Absolutely. When both big institutional camps are selling, that creates significant supply. It really underpins why the market felt that jitter, as the source put it, right at the start. It's unusual to see that much outflow on a day that ultimately ends up looking like consolidation.
And speaking of that jitter,
Mm.
this brings us neatly to the other big story. The SEBI ban on Jane Street. That seemed to hit like a shockwave.
It really did. The core issue. SEBI, the regulator, bans Jane Street. And Jane Street is, well, they're huge. A massive, high-frequency, high-volume trader.
So their sudden absence, people just didn't know how to react.
Pretty much, uncertainty immediately spiked. And it caused this ripple effect, especially hitting stocks directly connected to them.
And we saw that impact quantified, right? The sources named names,
Yeah.
Noama and Angel One.
Yeah, identified as Jane Street's main brokers in India, they were down drastically, as the source said.
And BSE shares, too, because of lower volume expected.
Makes sense, right? If a huge volume player disappears, the exchange itself sees less activity. So BSE took a hit.
Okay, that's logical. But CDSL,
Yeah.
Central Depository Services Limited, how did they get pulled in? I thought Jane Street mainly did index options.
That's the interesting connection. It's about collateral. Big firms like Jane Street often don't post cash directly. They use things like liquid funds as collateral. And those liquid funds, or similar instruments, are held and managed through the depository system. CDSL handles that. So if Jane Street isn't trading, the volume of those collateral movements also drops. Hence, CDSL gets impacted too.
Got it. So Noama, Angel One, BSC, CDSL, all down significantly.
Yeah.
The source mentioned around 5 to 10%.
Yeah, in that ballpark, which is a pretty serious single-day drop for these kinds of established companies.
It really underlines the scale we're talking about with Jane Street. What were the volume figures?
The source estimated they were trading somewhere around 45,000 to 50,000 crore each day.
Wow. Wow. The brokerage alone from that must be immense.
Absolutely enormous. So you can see why their sudden removal creates such a vacuum and hits their brokers and the market infrastructure so hard. It sends a real signal.
And this was definitely linked to that initial market nervousness we discussed.
Yes, the source explicitly called the Jane Street news the first jitter for the market today. It set a negative tone early on.
Important to distinguish, though the source also mentioned the stock trend was down sharply, over 10%, but that was separate.
Correct. That was due to a specific brokerage downgrade. Just happened on the same volatile day, but not part of the Jane Street fallout. Good to keep those separate.
Okay, so we had the internal consolidation dynamics, the Jane Street shock. What about external factors, global headwinds?
Right, you can't forget those. The Trump factor, as the source put it.
The tariff talk again.
Yeah, a tweet about starting to send letters to countries about tariffs. Apparently, that caused the market to dip further midday before it managed that recovery later on.
Just a tweet causing that kind of reaction.
It's a perfect example of how sensitive markets are to geopolitical chatter, especially from influential figures. Even the threat or suggestion of escalating trade disputes creates uncertainty, and markets react instantly.
And adding to the unique feel of the day, the U.S. market was closed for the holiday, right?
It was July 4th. So no direct cues coming from the U.S. overnight or during the day?
Which probably made our market even more sensitive to domestic news like Jane Street and that Trump tweet.
Very likely. Without the usual guidance or sentiment check from the U.S., markets can become a bit more insular, more reactive to local news or sudden global headlines like that tweet. It magnifies the impact.
So looking ahead now, the sources seem to be pointing towards continued consolidation next week, but maybe with some lingering volatility thanks to this tariff news.
That seems to be the consensus, yes. The options data points strongly to range-bound movement, but that tariff uncertainty is definitely hanging in the air. It could easily spark more volatility.
So for you listening, it raises that question. Are you prepared for potential bumps even within this expected range?
Right.
Geopolitical risk is clearly still a factor.
Definitely. And there's a specific caution in the sources, too.
Right, about the Jane Street-related stocks.
Yeah, the advice was to be a bit careful if you're holding anything directly linked, like Noama, Angel One, BSE, or CDSL.
Makes sense. They felt the immediate impact, and the full implications are probably still unfolding.
Exactly. They're likely to remain sensitive to any further news or analysis on this ban in the near term. It really highlights, the importance of understanding who the big players are and how the market infrastructure connects.
This whole Jane Street situation feels like it needs its own deep dive, honestly. The sources even hinted at maybe exploring it more in the future, looking at how to potentially avoid similar shocks.
It certainly warrants it. The implications for market structure, regulation, how quickly capital moves. It's a fascinating and important topic. We should definitely keep that in mind.
Okay, so let's wrap up today's deep dive. What are the absolute core takeaways?
I'd say three things stand out. One, the market's clearly in a consolidation phase, likely range-bound between 25K and 26K for Nifty near term, backed by options data.
Got it. Consolidation.
Two, the SEBI ban on Jane Street was a major shock, hitting related stocks hard and showing the ripple effects of regulatory action on high-volume players.
The regulatory ripple.
And three, global geopolitics, like tariff talk, remain a persistent source of volatility, adding complexity even during consolidation. Those three forces, consolidation, regulation, geopolitics, really define the day.
Excellent summary. And to leave you, our listener, with something to think about. We saw the market test that crucial third-day low today. We saw it absorb a major regulatory shock and react to sudden geopolitical news, yet still attempt to consolidate and recover.
So the question is, what does this tell you about the underlying resilience of these financial markets? Their capacity to process and maybe even absorb these unexpected hits, something to ponder.